Welcome to the ALX Show, your premier source for DFW real estate data and insights. Let's get to it. Hello and welcome back to yet another episode of the ALX Show. I have with me, as always, Josh Alexander, Patrick Dunn. Thank you both for joining me. How's it going, guys? How are you doing this Tuesday?
Grinding away. We're doing good. We talked last week a little bit about some storm damage on one of the properties. We've gotten that resolved, which has been good. One lesson there is have somebody on your team. We've got Christian, he's sitting here next to me. Have somebody on your team, that is great on the operations side, understands whatever it is you're in, but just understands how to do things effectively and efficiently. We have that on ours. So thankfully that played in our favor big time, because we were looking at initial quotes that were much higher than what we actually paid. So it's good lesson to learn. I mean, control what you can and, find the right people to work with and make some of those like seemingly, really hard or bad situations not so bad, right? It's just another reminder. It's all about the people.
That's right. All about the people and being on the ground, boots on the ground, people actually making things happen.
You got to jump in.
Decisions, got to jump in. Yeah.
Yep.
Yeah. Get your hands dirty. Love that. Well, speaking of getting your hands dirty, the last couple of years has been kind of a challenging environment for real estate, to put it mildly, put it vaguely. So we were talking about last week, tornadoes and tariffs, and there's lots of other things that have been impacting real estate. But one of the key things that have been driving the market over the last couple of years has been inflation. And as a result, interest rates and things like that. And so today we're going to talk about the last couple of years, as you guys see it, how inflation has affected real estate in general in North Texas, but especially on the commercial sector and what you guys are seeing there. And so, Josh, you've got some insight there. Patrick has some numbers, but then also what to look forward to. I mean, what is 2025 going to bring about this year? I mean, obviously uncertain. Nobody knows the future. I have no idea what will happen this afternoon. But, what are some things that you guys are paying attention to and looking forward to? So, Josh, I'll start with you. Tell me, as you see it, the story of the last 3 or so years, especially on the inflation side of things, the interest rate side of things, and how you're seeing that develop in the markets you're paying attention to.
Yeah, low inflation to high inflation, low interest rates to high interest rates is the story of the last 3 years. And now we're starting to see some relief, right, in inflation. I mean, it's come down pretty dramatically from where it was. We'll get the CPI out tomorrow and we'll see, how we're doing currently. But for commercial real estate, yeah, you hear a lot about the interest rate side of it, not as much about some of the expense challenges, inflation-related expense challenges, talking about taxes, insurance, really taxes, I guess, came along more about the elevated values from when interest rates were so low. Then we didn't have a lot of transaction volume, so there wasn't a lot of comps to really argue down taxes. So maybe not taxes weren't directly related to some of these other things, as related to inflation and some of these other expenses, but still a big factor, right? But insurance for sure, and when a claim costs more for a provider, they're going to require a higher premium, and that's what inflation did. Repair and maintenance, just the cost to get things done, payroll, a lot of the things that go in, utilities. I mean, things that go into managing and running commercial real estate, apartments specifically for us, all got more expensive. And then on top of increasing debt service as rates go up. And what I'm sure people, get this, maybe don't think about it too much, but you sign rents for 12 months. In the multifamily side, commercial could be 1 to 3 years, sometimes longer. And those rents are set for that period of time. So as expenses are going up, if they go up quickly, within that term, you don't have a way to offset those. Your cash flow is set. It's set, and then you've got to go collect it. But that your revenue is what it is, and then you've got to find ways to manage the increasing expenses, trying to get more efficient. But in some cases, expenses are just going up. You can be as efficient as you want, but it costs what it costs. So there's been lots of that. That has been an ongoing thing. We're starting to see though, where rent growth was stagnant, or was rents were actually decreasing in some markets much more than others. Here in DFW, slightly decreasing. We are starting to see signs that they're increasing again, and that's a matter of supply. There's just not enough housing. So we see that things are starting to look better. If you're a commercial property multifamily investor here in DFW, then you're starting to get more optimistic, like hopeful. There's light, and that light's getting bigger. We're getting closer to it. We're seeing some expenses come back in, maybe not grow as fast, but we're also seeing that rent growth come back, which is huge. And those of you paying attention, you'll see like on the 10-year, yields are coming back in. So that helps out quite a bit too. And so we'll see if we can continue that trend with yields moving down. In addition to rent growth, in addition to more manageable expenses, things are going to start to look a lot better.
Yeah, I saw a headline yesterday about treasuries coming down just because the past couple of days markets have been down. And I know that,
a lot of volatility, right?
Yeah,
I mean, people aren't sure what to expect. The trade policy is driving a lot of that. So when people aren't sure, then they're going to rush to safer assets. That's what we're seeing, right? They're getting out of the risky stuff and going to the safer stuff. So, but that helps us. If they push into the treasuries, then that pushes the yields down, and then we benefit from that. Everybody in commercial real estate and everybody that's looking to buy a home, mortgages benefit from that. Those come in as well too, as the 10-year comes in.
What's your thought on working from home in North Texas or maybe in Austin? You mentioned before we started recording Austin market. Have you seen any of that impacting the commercial real estate side and how that might be affecting that market where a lot of people are working from home for a lot of different companies, but then you have companies that are demanding people come back to the office as well? Does that play a part in any of this at all?
Very much. Yeah. If there's not a high demand for that office space, and they can't raise rents, right? And they experienced a lot of the same costs that I just talked about, over the last several years, and they need rents to go up in order to be in a better financial position on a lot of these office buildings. So if there's not a demand, if people are working from home, employers aren't requiring people to come back, or maybe they're doing a hybrid work week, so they don't need as much space as they once did. So they're downsizing. It's all about the demand for the space. Less demand means less rent. So that's hurting property owners in different areas. I think it's also dependent on location. Some of the, if you're in Dallas or Fort Worth or Las Colinas or some of the other major cities, major metro areas, you're probably seeing a lot more demand than if these office buildings that are, out in the suburbs are kind of like the mid-tier spaces, and especially if they're older, they're probably seeing, probably still hurting, just because there's just the cultural shift or the behavior change around working from home has just impacted demand for that space. And employers, it depends. A lot of times, if employers think, I need you guys to come back in order to be more productive, then they're going to require that, or they're going to find employees that are willing to come back. But I think in a lot of cases, especially on the hybrid model, they realize, well, maybe they're just as productive, 2 days in or 3 days in. Yeah. And so it's a more permanent shift to where a lot of these commercial property owners in these areas are going to have to figure out, what to do, or unfortunately just take a loss in value.
Yeah. Yeah, I heard from a friend of mine. He does some work with government agencies in DC, and he said a lot of the people that he works with, his clients, they're crammed into like conference rooms because of the emphasis or need for what the Doge and the president are saying, that people need to come back to the office, but they don't have the space. And so now there's just a bunch of people. He said, just find a chair, sit on the ground, whatever, but bring your laptop. And that's kind of the situation in DC right now. That's what I hear. So that was kind of interesting.
I think the general consensus I hear is people are more productive in the office, right?
Yeah.
It just depends. I think the ones that made the total change, COVID came, and they're traditionally they were in the office 5 day a week type culture, and then they tried to change or were forced to change to work at home. That's a big shift, and it totally depends on the business and the industry, and what kind of collaboration you need, and like, do you have a strong culture? Are you trying to build a culture? There's a lot of things that go into it. But
Tons.
I think more and more you're seeing employers believe that people are more productive and the businesses are more profitable with people in person.
Sure. Yeah. Huge debate. Lots going on in
Yeah.
industry,
There's a lot to
age
it.
group, tech savvy, all that kind of stuff. Yeah,
Right,
for sure.
right.
Yeah. Well, switching gears a little bit. So last year, last couple of years have been, as you described, very tumultuous. Lots happening. But what are you guys thinking about the next, couple of months, next year, 2025, even, next week? What are some things that you guys are thinking about when it comes to, how treasuries might be doing, but how you're seeing inflation stick or not stick? I mean, I know you said the CPI report come out tomorrow, but what are you guys kind of paying attention to and thinking about in the next few weeks or so?
Yeah, I mean, I think the outlook right now, economically and interest rate wise and inflation wise and all of that, for multifamily owners is improving. I know there's a lot of market uncertainty and all that, but the outlook's improving. I think pricing, like the price declines and everything, has bottomed. The Arbor, the big commercial real estate firm, puts out a quarterly report on small balance loan portfolio that they have. They originate a ton of Fannie and Freddie loans, and small balances, classified as $7.5 million loans and under. And they put out a report for the previous quarter a couple weeks ago, and the feedback in that report is that cap rates bottom in third, fourth quarter 2024. Values are starting to improve a little bit, and the loan originations are strong. Fannie and Freddie are originating a good amount of volume given the circumstances where we are. So everything seems to be, improving, and that's helpful for all of us.
Yeah, I was about to say that sounds great. I'm excited about that.
Yeah, I mean, the question is going to be, how quickly does that really change? Small improvements in value or, helpful movement in the right direction. But, most owners, if they want to make a move soon and get out and provide a good return, are going to need a pretty notable increase in values from where we bottomed out. And so now it's a game of patience and a game of capital. And who has the capital to be able to withstand the value recovery are the ones who will, be the most successful, and the ones who don't are going to be the ones who end up having to sell and getting out of it. And, we're starting to hear whispers of that, talking to other brokers, and that kind of thing is starting to happen.
So if I understand you right, basically whoever has deeper pockets to wait out this next season is going to be the ones who will be successful on the other end. Is that what I'm hearing? Yeah, interesting.
Yeah, the guys or the groups that have strong financial backing, are the ones that are still around, really, probably. I mean, some may just be incredible operators, and they could, figure some things out. Yeah. But I think the ones the financially strong or financially supported groups are going to be the ones that should be able to get through this, but with an emphasis on operations too. I mean, there's a lot that goes on to ownership. That you've got to be strong in all areas to survive. Yeah. But it's a lot of the groups that we see that are getting hurt right now are ones with big portfolios, with lots of properties that are hurting. And then it's really difficult, right? To big portfolios, large properties, several in bad places. That's hard because now you're trying to cover. You need a lot of cash in a lot of different places, and that's a hard sell a lot of times, right? If you look across the whole portfolio and it just looks like there's a lot of leaks, I mean, it can be hard to come up with the cash, and lenders will only be so patient. So, if you bought a ton of property up until 2022, let's say you loaded up in 2020 through 2022, and you bought the big properties and the expensive properties, and you put a lot of bridge debt on it, you just got a lot of holes to fill. There's just a lot of properties need financial support, and so it's just difficult to come up with all that cash. So those are the groups that we're seeing are having a harder time.
Yeah, Brandon, if you like to just put some numbers to it, if you bought a property in 2021, everyone was buying with the floating rate bridge debt. We've kind of beaten that horse, but because interest rates were so low, and so the typical structure of those loans were an initial 3-year term with 2 1-year extension options. So if you bought in 2021, your initial maturity was last year in 2024. And if you couldn't refinance into something permanent, you've got your first annual extension option. And lenders were, I think, across the board, largely willing to play ball with extension 1, which happened 2024, could be happening right now if you bought in 2022. And what it means is, in order to execute that, is you've got to pay an extension fee. You might have to buy a new appraisal. You've got to do a new property condition assessment. You're going to have to buy a new rate cap for another 12 months. And, you total all that up. And on a smaller property, a property our size, it's going to be a few $100,000. On a bigger property, it's going to be, over 7 figures. Just to keep going for another year.
Gosh.
But that largely happened. And what is happening now, or what we've been reading and hearing is happening now, is extension 2 is coming around. And the idea with extension 1 was, hey, we'll give you another 12 months to get you prepared for a full takeout to where we can get paid off and get out. Well, a lot of people still don't have the NOI capable of refinancing the cost of the loan plus the cost of the extra money that they had to put in to extend it. And so they're in the same spot. And going back to the lender and saying, hey, we would like to extend again. And lenders are definitely tightening how they are going about those extensions. And not that they're not doing them, but they're, going a lot more to the letter of the law of the loan agreement than they were the first time around. And the idea is, I think they're trying to slowly push everyone out. And so I know we've got low maturities are like a big discussion, and I've got some numbers behind that too, but I'll leave it there with kind of the extension options and what's been happening.
Yeah, I think that's an interesting point, because we were talking just before this about this kind of like debt wall, maturity. There was this report I read, I can't remember. I think it was from Goldman. Don't quote me, but I think it was from Goldman, saying that there was this wall of debt that was maturing in the latter half of 2025. I want to say it was like 80 billion or something like that, within especially the commercial sector. And so I think there's been some talk about, wow, all these loans are coming to mature, and if properties can't refinance, there's going to be some trouble, some bigger impacts into the market. Some people have talked about contagion and how it affects other things, but you guys mentioned that not super worried about that, because there are lenders don't want to take that asset back on. There's a lot of other things that come with that. They're not set up to do that. So ideally, they'd like to refinance and figure things out. And Patrick, you're saying like that is the case, but it is getting a little bit harder. Is that right? Am I tracking with that story?
Yeah, well, okay, let me paint a picture for you guys, and you guys tell me if you think that the looming debt wall is going to be catastrophic or if it's just going to be, something that really stinks to have to work through.
Oh boy.
Okay, the Mortgage Bankers Association put out a study about 2025 commercial real estate loan maturities, and they estimate that about $1 trillion of commercial real estate debt is coming due in 2025, which is a big number. That's about, a fifth of all of the commercial real estate debt that's apparently outstanding, about 5 trillion. So there's $1 trillion outstanding. They estimate that 14% of that is multifamily debt. So from $1 trillion, you're at what, 140 billion of multifamily debt that's maturing in 2025. Then from further, they estimate that at least 25% of that is debt held by a bank. So that would be fixed rate, probably been on the books for at least 5 years. Stuff that you wouldn't necessarily think is going to be in a refinancing trouble, like something originated 3 years ago. Okay. So take another quarter off of that, and you're under 100 billion, which is a big number, of course. And anyone invested in any of those deals, it's an important dollar to them. But I don't know how much you would guess of the 80 million or 80 billion left over is like the floating rate bridge debt, maybe 30 to 50% of it. So, I mean, you're in like, somewhere from 25 to 50 billion of maturing floating rate bridge debt in 2025 that all have extension options. So if the borrowers have the capital to extend them, they will. A portion will get extended, a portion will get refinanced. We're doing one right now that we extended once last year and are refinancing here next month. So, you could be looking between or maybe around 10 million of stuff that can't get refinanced and can't be extended that has a forced sale on it. And that's a big number, but that's a drop in the bucket, compared to the total pool of what's outstanding. You tell me if you guys feel the same way.
Well, I am a dilettante compared to you two, so I don't know. But that doesn't sound like a lot. I mean, 10 billion, 80 billion, anywhere even remotely near that number. I mean, there's people, lots of people in the United States that could literally pay that off, by just the super rich. So that doesn't sound like a crazy number. Yeah, I don't know how that strikes Josh, but that doesn't sound like a lot to me.
And then we need to add more context to it. I know, Patrick, if it says that's a national amount, right? So I wonder how much of it is, real estate is all about where you are. It's all about the locations, and every location market is going to be a little bit different. If you're in a place, if you've got, you've worked through an extension, you've got your next one up, or you need to refi, you've got pressure to do so. I think a lot of what the lenders are looking at is, one, they're looking at how well you've performed and what's your plan. How are you going to take them out? But then two, more market wide, like in the market you're in. Like what's the forecast? What's the likely trend over the next 6 to 12 months? That's going to play a big role. And how many properties these lenders have in those markets. You think about if they start taking properties back and selling them, likely at a loss, then that's going to impact their whole loan portfolio. Especially these lenders that that's all they do is lend to multifamily and commercial. And you think back to like you just said, these lenders are not set up to own. Now they figure it out. They got their REO department and they figure out if they do got to take something back. And I'm sure they hire a property manager. But if the person that they lent to, who is supposed to be experienced and able, is not able to get it up to a certain value, I think a lot of these lenders look at that like, well, what are we going to do different? How are we going to, like, we're not going to be able to devote our full time and effort and energy to getting this property where it needs to be. So I think that, that comes into play as well. So it's, what's the history with this borrower? What is the market? Where's the market going? Like, do we think values are going to improve? Is there going to be higher demand if they need to sell? Or do we think like lending conditions are getting better? And two, are we willing to take this on and manage it ourselves? And if we are, do we think we can do a better job than this borrower? So that there's, I think, a lot there that you'd have to, that's very specific to each loan and to each property and to the different markets. It is a big number, but hopefully, like, and we're blessed. I mean, I thank God all the time that we're in DFW, that this area is doing so well. We've got a bright outlook here. If you have this same conversation in some of the other markets around the country, you might not be, as hopeful. Where that number, and depending how much it affects them directly, might sound a lot bigger. So it is a big number. It's always concerning. Like, you always hope that, not necessarily concerning, but it's always something to be aware of. But I think when I hear it, it just, to me, it's like, well, you just got to get, you got to do your job. It means focus on leasing, focus on expense efficiencies, try to drive NOI best you can. Be in communication with your lenders, like go to them before they come to you, if you can. Let them know what's going on. Let them know about your plan. Let them know. That's what we do, right? We put together, Patrick puts them together, our like 6-month, 12-month, financial plan to where we expect to be, and this is why. And if you can couple that with a really like strong economic outlook for in our case for DFW over those next 6 to 12 months is how we think things are going to go, then I think lenders are much more likely to extend even, or short term, or just be flexible and to get you to a place where you can either sell or put some permanent debt on it. So there's just, I guess it goes back, there's just a lot of context, I think, that needs to be included into the conversation. And it's impossible to do that. Those are great numbers. Those are great stats. But to really, I think you dive into the different markets and different borrowers and the different situations.
Yeah. Yeah, it's a national number. It's kind of an average picture, but there's a lot in each market and how people are looking at different things. So what advice, given what we talked about, this is the last question, given what we talked about this episode, what advice would you give to DFW real estate investors or Texas real estate investors in general? Kind of the kind of folks that you talk to and have listeners in the show and read your newsletter and things like that. What advice would you be giving them given what you know right now?
Be selective. It's real estate, commercial real estate, especially multifamily, is still a really great investment. It's a big need. I think we're going to see higher demand on investment in DFW real estate too, especially as you see kind of the stock market wobble and different things. I mean, the stock market's still doing great relative, it's had a great run here, but I think you're going to see people start to look more into real estate again now that we're seeing it start to falter just a little bit. As interest rates come back in, as those yields come in, people are going to get, not to mention the bonus depreciation that's back on the table. There's a lot of things happening that are making real estate investment, especially multifamily real estate investment, more and more attractive now and in the near future. So I'd say just be selective. Find like the basics, right? Find properties where you can add value in great location, and thankfully in DFW there's a lot of great locations. And it doesn't have to be in the middle of downtown, right? I mean, it's sprawling, it's active and growing in all directions. So be selective, but don't sit it out, because if you sit out, you miss out. So just stay diligent and find the right people like we talk about. Make sure that you can evaluate well and that you can verify that it is a good deal by with the right professionals and the right experience around you. Set up great debt. That's what we learned. Like, if you have to raise more money in order to get better terms, take a chance on yourself and go out and try to raise more money in order to set up debt that's really going to work for you, and something that's we're now big believers. A lot of our stuff is fixed, but we're big believers down fixed debt. But when you're first starting, like Patrick mentioned, the bridge loans. If you wanted to buy property in DFW or in a lot of places across the country from 2020 to 2023, you weren't going to compete. Like your offer was not going to be competitive if you didn't use this bridge debt. Now it could have been you had to raise a lot more money, because the bridge debt was what allowed you to use it to get a lot more leverage, so you could get more competitive. You raised less cash, so there was less pressure on the return because there's just less capital to make the return on. So it just made sense. If you wanted to buy competitively those last few years, it's kind of what you had to do. Moving forward, I will emphasize though, at the time, the dot plot was what, like maybe 75 basis points over the next year and a half. So you just never know. Yeah. So my advice moving forward would be, do everything you can, try to make the fixed rate work, and raise more money in order to do so, unless it's abundantly clear that rates are going to come in, you want to ride them down a little bit, but generally look for that fixed rate. Bet on yourself. Make sure it's a good project. If it is, the money will come to it, and go raise what you need in order to allow you to get the debt that's not going to put you in a bind later.
Yeah, I feel like we could have a whole episode about take a chance on yourself, take a bet on yourself. You know what that looks like, and how you even just emotionally like go through that. Like even last episode, what we were talking about, just like, kind of riding the lack of control that one has, but betting on yourself, betting on your skill sets, betting on your team, betting on your partners, and just riding it out. Well, guys, thank you so much. Love your insight as always, and I hope that listeners, investors, folks that are focused on the real estate market, especially in DFW, get a lot of value out of your expertise, because I know I do. So thank you, and we'll see you guys again next time.
All right. See ya.